All right, so let's go over chapters 1 through 4. So whether this is for a midterm or a project coming up in your Accounting 111 class, we're going to be going through the entire accounting cycle. So we're going to see all these transactions, we're going to journalize them, post them into T accounts, prepare a trial balance, we're going to then journalize and post adjusting entries, prepare an adjusted trial balance, prepare all of our financial statements that we need, and then we will finish it up by journalizing and posting our closing entries and preparing a post-closing trial balance. So, if we get started here, the review says Artichokes LLC began operations on July 1st. And so the very first transaction listed for us is Artie, the owner, invests $30,000 cash in the business Artichokes LLC. So whenever an owner invests cash in the business, the company will be getting cash, so we need to affect the cash account. And Artie is getting a piece of the business, right? So owner's capital also has to be affected. So since the company's getting more cash, we will increase our cash with a debit, because assets go up with debits. So we debit our cash for $30,000, and then owner's capital goes up with a credit, so we will credit owner's capital $30,000. So whenever you see a transaction talking about an owner investing money in a business, that's the framework that we're going to deal with. The next transaction, on July 1st, Artichokes LLC signed an office space rental agreement paying $6,000 for 6 months worth of rent. So if we were paying just for one single month, then we'd be looking at rent expense. But if we're paying for 6 months in the future of rent, that's where prepaid rent comes into play. So prepaid rent is an asset, and it is going up $6,000. And then how did we pay for this prepaid rent? Well, we used cash, right? Whenever it says that we paid something, we know that that means that cash is leaving the business right now. So cash is decreasing $6,000, so we credit cash. Now on July 3rd, the company purchased $15,000 of equipment, paying $5,000 in cash right now, and the remainder will be on account. So this is going to be what's called a compound entry. There's 3 different accounts that are being affected here. So if we break this apart, the company's buying equipment, they're paying for some of it in cash, and then they owe the rest later on. So the company's getting this $15,000 of equipment. Equipment is an asset account, and so we want to debit our equipment for that $15,000. Then we look at how we paid for this equipment. So we paid $5,000 in cash, so we want to end up decreasing our cash. We want to credit our cash for that $5,000. And then whenever we see that we owe money later, we owe the remainder on account, that's where accounts payable will come into play, because we will be paying them the money later on. So we end up here crediting cash $5,000 and crediting accounts payable, which is a liability account, that $10,000. So what's important to notice here is that your equipment of $15,000 equals the sum of your 2 credits, right? So whenever we have a journal entry, we always want to make sure the sum of the debits equals the sum of the credits. So 15,000 equals 5,000 plus 10,000. So if we move on to the next transaction here on July 6th, we buy $500 of supplies on account. So there's that on account again. So what is the company purchasing? The company is purchasing supplies. And supplies is an asset account. And so we'd want our asset account to go up. So to make our asset account of supplies to increase, we will debit supplies. Now, how did we pay for these supplies? It tells us that we bought them on account. So that's telling us, just like what happened with the equipment in the last transaction, that accounts payable is being affected here. So we end up crediting accounts payable for that 500 because the liability will be increasing because we owe more money. So we want to increase that liability account with a credit. Now here on July 10th, the company received $10,000 from a customer for future services. So here on July 10th, when they received $10,000 for future services, they are getting money right now. So when the company is getting money, we want to show that as cash being debited because the cash that they have is increasing. So we need to increase that company's cash. Now, why did we receive this cash? So it says we received the payment from a customer for future services. So if we received payment for future services, that tells us that we are dealing with unearned service revenue. And so if there's unearned service revenue, that's a liability account. So we want to increase the unearned service revenue by $10,000. And to do that, we credit unearned service revenue for that $10,000 amount. So moving on to July 12th. Says Artie withdraws $1,000 cash for personal use. So Artie's taking money out of the business. Whenever the owner takes money out of the business for personal use, we call that owner's drawings, right? So we will debit our owner's drawings for this $1,000. And then what is Artie taking out of the business? Artie is taking cash out of the business. So the company's cash is decreasing because we always want to make sure that we're looking at these transactions from the point of view of the company, not of the owner. So the company is losing cash here. So we want to credit our cash for that $1,000. So now on the 14th, you performed services worth $3,000 and billed the customer for the amount. So if we are billing the customer, that means the customer is going to be paying us later for all of these services. And when that happens, what we call that is accounts receivable. So we will be receiving the money later on. So it's accounts receivable. That's an asset account. So it is increasing with this debit of $3,000. Now, why do all of these people owe us this $3,000? Well, we performed services. So whenever you see that you performed a service, we call that service revenue, right? So even though we aren't getting paid right now for these services, right? These people are going to pay us later on. We still need to count the service revenue when it happens. And so we want to count this revenue here on July 14th. This $3,000 worth of work that we did, we count the revenue today. So now on July 18th, we paid employees a total of $2,000. So we are paying our employees salaries right now, right? So whenever we pay salaries, we can be thinking of expense accounts. And luckily, we have an expense account called salaries expense, right? And expenses go up with debits, so we will debit our salaries expense for this $2,000. Now, how are we paying our employees? Well, we're going to use cash, right? We're going to write them a check or use cold hard cash. Either way, we call it cash. So we will credit our cash for $2,000. Now here on the 21st, tells us that we received payment in full from customers billed on July 14th. So back on July 14th, we performed these services worth $3,000 and we billed these customers. A week later, they're paying us back. So us as Artichokes LLC, we're getting money. We're getting cash. And whenever we get cash, we want to debit our cash. So we debit our cash for that full $3,000 amount, since that's what we billed them a week earlier. Now, we also want to show in our books that these people don't owe us this money anymore. So what we end up doing is we credit our accounts receivable because they now owe us $3,000 less. So we are decreasing that accounts receivable account by this $3,000. Now here on the 28th, it says pay creditors $2,000 for amount owed. So whenever you see paid creditors, creditors are just people that you owe money to. So you're paying people that you owe $2,000. So if we're paying people money, we know that our cash has to decrease. And so we've talked about that before. To decrease cash, we credit our cash. But what account are we going to debit? So if we are paying these people back, that means that we don't owe them that money anymore. And the account that we use to show what we owe other people is accounts payable. So we're going to end up debiting accounts payable, which decreases that liability account. So we debit accounts payable $2,000, and then we show that our cash is also decreasing, and so we credit cash of $2,000. Now our last transaction here on July 30th, it says we performed services for a customer. So we earned $12,000 in revenue, received $8,000 in cash, and the remainder is on account. So just like back on July 3rd when we bought all of that equipment, this is going to be another one of those compound entries. Right? We have 3 different accounts that are affected here. We earned revenue, we got cash, and people owe us money. So, if we are receiving cash, we know that our cash has to go up. And to make our cash increase, we want to debit our cash of $8,000, because that's the amount of cash that we got. Now, the other 2 pieces here. We earned revenue of $12,000. So if we look back on July 14th, when we earned revenue there, we credited service revenue. So we're going to want to end up crediting service revenue for $12,000 here in this problem as well. But then we have that middle piece talking about the remainder on account. Well, that remainder, people owe us money. And when people owe us money, we want to debit accounts receivable of $4,000 here, because that's the amount that was on account that people will pay us down the road. And then, like I was saying, we want to credit our service revenue for $12,000. So those are all of our journal entries for our transactions. Now, part B of this problem is to prepare a trial balance. There's no way that just looking at these journal entries real fast, you know what the balances in all these accounts are. So what we need to do is we need to post these transactions into T accounts or into a ledger. So we're going to use a T account here. So what we'd want to do is go through all of those journal entries that we made, and we want to post them into this T account, which is a term used for just putting them into this T account. So over on the left side of a T account will be your debits. So anytime you debit cash, you'll put that number over on the left side. Credits go over on the right side. So anytime you see a credit to cash, you would put that number over on the right side. So if we go through this, if we go transaction by transaction, the very first transaction that we did, we debited cash of $30,000. So we'll put that $30,000 over on the debit side. Then, in the next transaction, we credited cash of $6,000. So we'll put that $6,000 over on the credit side. And if we keep working through, we see on July 3rd, we credited cash of $5,000 back when we bought that equipment. So we credit $5,000 here in our T account. On July 10th, we received money, and so we'd debited our cash of $10,000. So we put that debit of $10,000 in our T account. On the 12th, Artie took money out of the business, so we credited cash back in our journal entry. So we show the credit to cash here in our T account. Next transaction that affected cash was when we paid our employees. When we did that, we credited cash of $2,000. The next transaction, we received money, and we ended up debiting cash of $3,000. Then we paid people back on the 28th, and we credited cash $2,000 once again. And then our very last transaction, we had a debit of $8,000 to cash. So we now have our T account filled out for cash. So the step, once we fill out all of that, is to figure out the balance in that account. So what we'd want to do is we want to add up all of our debits and add up all of our credits. And we want to see, okay, which side has more. So if you add up all of your debits, you should end up with $51,000. Right? So we have $51,000 worth over on the debit side right now. Over on the credit side, if you add up those 5 credits, you'll have $16,000. So we know that there's more over on the debit side right now. So that means that our balance is going to be over on the debit side. To figure out what the balance will be, we'll take the total amount of debits that we have, that 51,000 that we found, when we added up our 4 debits, and we subtract out all of our credits. So when you take 51,000 minus 16,000, you end up with a debit balance of 35,000. So we can then use T accounts to find the balances of the rest of these accounts. Right? So if you are watching this review back, I would recommend pausing the video here and going through all of your transactions, all of your journal entries, and finding the balances for each of these following accounts. When we find the balances, we'll find that accounts receivable ends up with a balance of 4,000. Supplies is 500. Prepaid rent, 6,000. Equipment, 15,000. Accounts payable, 8,500. Unearned revenue, 10,000. Owner's capital, 30,000. Owner's drawings is 10,000. Service revenue is 15,000. And salaries expense is 2,000. So we now have the balances in each of those accounts. So the next step is to finally prepare this trial balance. So we can now prepare a trial balance. So a trial balance is going to list out all of your accounts, and then those balances that we found on the last slide, we're going to list those out as either a debit or as a credit balance, depending on that account's normal balance or which side the balance ended up on when we were using the T accounts. Now, when we list out the accounts here on trial balance, there's a certain order that we want to list them in. We can't just list them however we want. So we want to list them in the order of the expanded accounting equation. Right? So we're going to list our assets, then our liabilities, then our capital, our drawings, our revenues, and our expenses. So, starting off with assets, there's another rule of how we list out our assets as well. For assets, anytime you list out assets, just get in the habit of listing them in order of liquidity. What that means is how quickly they can be turned to cash or how quickly they can be used up. Right? So the most liquid asset is always going to be cash. And so we found earlier cash had a debit balance of 35,000. After cash, we'll list accounts receivable, debit balance of 4,000. Then supplies, a debit balance of 500. Prepaid rent, a debit balance of 6,000. Equipment, a debit balance of 15,000. And those are all of our assets. So cash, accounts receivable, supplies, and prepaid rent, those are all current assets. Those are things that we expect to use up within the year. Equipment are things like a computer or a car. If a company buys equipment, they don't want to use that up in a year and get rid of it. Right? So equipment, buildings, and land, will fall under a category called property, plant, and equipment, or a long-term asset. So those are always listed after your current assets. But once we finish up all of our assets, we can then move on to liabilities. So our liabilities here, accounts payable, you can notice now the balance for accounts payable is no longer in that debit column like all of our assets were. Accounts payable is a liability. Liabilities have credit balances. So the $8,500 balance for accounts payable is over in the credit side. Unearned service revenue with its $10,000 balance. And that's all of our liabilities. So after our liabilities, we then want to list out our equity accounts, right? And equity gets broken up into capital, drawings, revenues, and expenses. So we want to list out owner's capital, which has a credit balance of $30,000. Then owner's drawings has a debit balance of $1,000. Service revenue, a credit balance of $15,000. And salaries expense, a debit balance of $2,000. So we've listed out all of our accounts here. So we're almost done with the trial balance. There's one more step that we need to do. We need to make sure that all of our debits, when you add them all up, equals the sum of all of our credits. So if you add up your debit and credit column, each of them should add up to $63,500. So if that happens, you are probably on the right track. It's not definitive, but you at least know that you haven't done anything too terribly wrong so far. So after preparing a trial balance, the next step here was to journalize and post adjustments. So this is chapter 3 in your textbook. So these adjusting entries, right? There's a couple rules that we can follow when preparing adjusting entries. First of all, we will never, ever use cash in adjusting entries. Our second guideline to follow here, we will either debit an expense or credit a revenue. And then that remaining account in each adjusting entry has to be a balance sheet account, right? So we'll go through these 5 adjustments that we have and figure out what these entries need to be. So these adjustments, all of them are going to be happening at the end of the month also. So here on the 31st, our first adjusting entry says $150 of supplies were used in July. So we used up supplies, right? So we want to decrease our supplies account, and supplies is an asset. So to decrease an asset, we want to end up crediting supplies, which means that our debit has to be an expense. And the expense that we're going to use here is going to be supplies expense, right? So if we come through here, you'll see supplies expense of $150 and then crediting supplies of $150. Our next entry, employees are owed $1,800 and will be paid on August 2nd. So it's July 31st now, so we aren't at payday yet. So we owe them this money. So we can think, okay, is it going to be an expense or is it going to be a revenue? Are we making money because we are paying our employees? No, right? So we're looking at an expense. So we have a salaries expense account that we have already used in this review, right? So we'll debit that salaries expense, $1,800. And then we aren't paying our employees right now. We are going to be paying them in a few days. So if you owe them money, we have to be thinking of a liability account. Now, accounts payable is what we use when we owe a creditor money. But if we owe our employees their salaries, we have a special salaries payable account. So we'll use salaries payable here and credit that $1,800. Our third adjusting entry says the equipment has depreciated $125 this month, right? So when you buy a car, over time that car is going to lose value. So we call that depreciation. So here we're looking at another expense. So we're going to call it depreciation expense. So we'll debit our depreciation expense, $125. And then we will credit this new account for Chapter 3. It's a contra asset account. So it's going up with this credit. It's called accumulated depreciation equipment. Right? So it's going to be a contra asset, and we will see later on in this problem how that affects our assets on a balance sheet. Our fourth adjusting entry here, $8,000 of unearned revenue remains unearned at the end of the month. So we initially had $10,000 worth of unearned service revenue. Now, at the end of the month, $8,000 of it remains unearned, which we can flip that around and say that we've earned $2,000 of it. So this transaction, or this journal entry, needs to show that we have earned $2,000 worth of revenue. So we would want to make sure that we show in our books as well that we have $2,000 less of unearned service revenue. So we want to decrease that liability account. And if we decrease that liability account here with this debit of $2,000, that then tells us that the account that we have to credit here, if we go back to those rules that we talked about at the start, this account has to end up being a revenue account. So we will credit our service revenue for $2,000. So all we're doing there is we're moving that $2,000 out of our unearned service revenue and into our service revenue account. Now this last adjusting entry says 1 month of the 6-month rental agreement has expired. Right? So back on July 1st, the second journal entry that we did today, we signed an office space rental agreement and we paid $6,000 for 6 months of rent. Well, July has now run up, so we've used 1 month of this rental agreement. So we have to show that we have less prepaid rent now. So we would have to decrease our prepaid rent account, which means we need to end up crediting prepaid rent, which leaves the debit slot open for an expense. That expense, rent expense, right? So we debit rent expense, $1,000, and we will credit prepaid rent, $1,000, because that is 1/6 of the $6,000 original rental agreement amount. So you'll notice looking at these adjusting entries, words are similar, right? Supplies expense, supplies. Salaries expense, salaries payable. Depreciation, depreciation. Rent, rent, right? So if you are getting stuck, try to come up with some sort of expense account that just deals with what the adjusting entry is talking about, right? That's always going to be a crutch that you can use here. So after you prepared all of those adjusting entries, you then have to post them, because the next step here is an adjusted trial balance. So what we would have to do is we'd have to go back to those T accounts that we made for all of those original accounts and figure out the changes that happened in these adjusting entries, right? So if we take a look at that first adjusting entry that we made, our supplies decreased by 150, right? So we would want to show on our T accounts that we credited supplies 150, and since we originally had $500 worth of supplies, our new adjusted balance is $350, the difference between that original $500 and this $150 credit. So if you go through and find each of those, you'll see your supplies should now be at $350. Your prepaid rent should now be down to $5,000 because we used up some of that prepaid rent. Your unearned service revenue decreased. That's now down to $8,000. Your service revenue increased, right? Because we earned some service revenue here. So that increased and should be now $17,000. Salaries expense increased. That's now at $3,800. And then you'll also notice that there were some accounts that you used here in your adjusting entries that you hadn't used in your original journal entries. And so supplies expense, salaries payable, depreciation expense, accumulated depreciation, and rent expense, all of those will need new T accounts to show that they now exist. So now we can create an adjusted trial balance. So in an adjusted trial balance, we want to now use all of these new balances that we found after our adjusting entries. So we still want to list them out in a similar order as we did before, right? Assets go first, and we list out our assets in order of liquidity. So the very first asset that's going to be listed, that's going to be cash. All right, so we list cash. Cash was not affected in our adjusting entries, so it still has that $35,000 debit balance. The next account is going to be accounts receivable again. That was not affected, and so that still has its $4,000. Supplies comes next, and supplies is where we see our first change in the number for our adjusted trial balance versus our trial balance that we did earlier. So supplies now only has $350 worth in it. So we list that $350 under the debit side. Then we have our prepaid rent. That's now down to $5,000, so we list $5,000 as its debit balance. Then we have equipment. Now equipment was not affected in our adjusting entries. the equipment depreciated, but that went into two other accounts. So the equipment account is only ever affected whenever you buy equipment or whenever you sell equipment. When it's depreciating, we do not affect the equipment account directly. It gets affected indirectly by the next account we want to list, accumulated depreciation equipment. Right? So that account gets listed right underneath the equipment account here on your adjusted trial balance, and it has a credit balance of 125. So now we can start listing out our liabilities. So we have accounts payable. That was still at $8,500. Then we go to our unearned service revenue. Remember, that decreased by $2,000. So that has its new balance of $8,000 over on the credit side. And then we had this new liability pop up in our adjusting entries. We had salaries payable. So we want to show salaries payable here underneath our unearned service revenue. And salaries payable has a credit balance of $1,800. So those are our liabilities. Now we move on to the equity portion, right? So our capital, drawings, revenues, and expenses. So we list out our capital. Our owner's capital has not changed, right? Still just $30,000. Owner's drawings comes next. Drawings have not changed, still at the $1,000. After our drawings comes our revenue accounts. Well, the revenue account that we used here was service revenue. Service revenue increased and was now at $17,000 because we earned that $2,000 worth. That's our only revenue account. So then we start listing our expense accounts. So we had salaries expense, which is now at $3,800. That's over on the debit side. We had rent expense. Sorry, that should say $1,000. So we had rent expense of $1,000. Supplies expense of $150. And depreciation expense of $125. So we've now listed out all of our accounts. Just like we did in the initial trial balance that we made, we now need to total up all of our debits and total up all of our credits to make sure that the two sides equal. So when you add up all of your debits and you add up all of your credits, each side should equal $65,425. And again, just because they add up doesn't mean that everything was correct, but it means that you're probably on the right track. Right? So if they didn't equal, then we'd have to go back and find a mistake. But if they equal, we can just move on with our day and assume that we did everything correctly. So after making an adjusted trial balance, we can then start preparing financial statements. Right? So there's 4 financial statements that you need to know for this class. There's the income statement, there's the owner's equity statement, there's the balance sheet. Those 3 you're going to need to know how to prepare. The 4th one, a statement of cash flows, you just need to know that it exists, that it is out there. That's going to be something that you'll learn later on in your accounting classes. So, I listed out those financial statements in a certain order. Income statement, owner's equity statement, balance sheet. That's because that's the order that we're going to be preparing these statements, right? So the first statement you want to prepare, that's going to be your income statement. Now you'll notice up at the top, it has the company name, the statement that you are preparing, and for an income statement, it's going to say for the month ended July 31st, 2020, right? This is just for July. So an income statement's always going to be for the month ended, for the year ended, for the quarter ended, depending on what you are preparing the statement for. So, what goes on an income statement? Well, the goal of an income statement is to find our net income, right? So we find our net income by listing out our revenues and listing out our expenses. So our revenue accounts here in this problem, we only had one of them, right? We had service revenue. So we can list service revenue, and we can put that $17,000 that we get from the adjusted trial balance, right? We're taking all of our numbers from that adjusted trial balance now. We take that $17,000 and we put it on the far right side of the income statement here. And the reason we do that is because we only have one revenue. If we had multiple revenues, we would put that $17,000 more so in the middle, and then we'd have to add up all of our revenues and show the total revenues over on the far right. We'll see that now with the expenses, right? Because we have 4 different expense accounts. Now, you can list out your expenses here from greatest to least. So we had salaries expense of $3,800. You can notice that that number is now more so in the middle compared to where we have that $17,000 for service revenue. After salaries expense, rent expense of $1,000, supplies expense of $150, and depreciation expense of $125. Right, so now we're going to want to add them up. So we draw a line underneath those 4, and we list our total expenses, which adds up to $5,075, and we list that number along the far right-hand side. So then that way, when someone's looking at an income statement, they can look on the far right and see total revenues, total expenses, and then the bottom line of the net income. So we find our net income by doing revenues minus expenses. So we'll take our $17,000, subtract our $5,075, and we get a net income of $11,925. Now, the reason that we did an income statement first is because we're going to need that net income amount to help us fill out this next statement. So the next statement we're going to make is an owner's equity statement. Once again, owner's equity statements are for a period of time, right? For the month ended, in this case, could be for the year ended, for the quarter ended. It's for a period of time. So the very first line of an owner's equity statement is going to be your beginning capital. Now, our beginning capital here is at the very start of July, right? So it tells us that in the problem that Artichokes LLC began operations on July 1st. So that means that at 12:01 a.m. on July 1st, there wasn't any money put in the business yet. So the owner's capital at the very, very beginning of July is 0. So we can put that 0 there for our owner's capital on July 1st. Then we go into the add section of our owner's equity statement. So there's two different things that we can add on an owner's equity statement. We can add investments and we can add net income. So in our problem, Artie made an investment in the business back on July 1st. So we show that investment of $30,000. Now, once we list that out, we can take a look back at our income statement that we made. According to that income statement, we made a net income of $11,000. Right? So then we list out this net income of $11,925. So those are our two pieces that we will put into the add section. And you can notice they're in the middle, right? Because we're going to have to do math. So we draw a line and we add those two numbers up, the 30,000 and the 11,925. We add them up and we put that number over on the far right. So that's how we get that 41,925. Then we need to add up that 41,925. We add that to our beginning capital. In this case, our beginning capital was 0, so we still end up with 41,925. But just know that we aren't just bringing that number down. What we're doing is we're doing 0 plus 41,925, giving us that 41,000 number once again. So we're done with the add portion of the owner's equity statement. Now we have this less portion, right? Things that we will be subtracting. There's two different things that can be subtracted on an owner's equity statement. First of all, we have owner's drawings, right? Any time that an owner takes money out of the business for personal use, that's going to decrease their equity. The other piece is net loss. So if we would have had a net loss on our income statement, meaning our revenues were less than our expenses, that net loss would show up here on the owner's equity statement under less. So in our case, the only thing that will go under less is that $1,000 worth of drawings that we made. So since we only had one piece under this less category, that 1,000 can go over on that far right hand side in line with that 41,925. So after we list out our less category, we can then calculate our ending owner's capital. Our owner's capital on July 31st. So at the end of the month, our owner's capital in this case was $40,925. So we got that number by subtracting that 1,000 from the 41,925 that we had right above it. So that's how much Artie had in his capital account after the first month of business. So after we finish up this owner's equity statement, we can then move on to our third financial statement, the balance sheet. Now, if you look at the top of your screen here, you'll notice it has Artichokes LLC, balance sheet, and then just July 31st, 2020. There is no for the month ended, for the year ended. It's just the date. A balance sheet is a snapshot in time. So a balance sheet will always just have a specific date rather than the for the month ended examples that we saw on an income statement and owner's equity statement. So a balance sheet, what a balance sheet's going to prove here is your accounting equation, right? So your accounting equation is assets equals liabilities plus owner's equity. So we're going to want to list out all of our assets first. So when we're listing out our assets, like I said earlier, we always want to list them out in order of liquidity. So we already have that order of liquidity and their balances from that adjusted trial balance, right? So we're going to reference that adjusted trial balance as we're preparing this balance sheet. So the most liquid asset, it's always cash. So we list cash first. After cash, we have our accounts receivable, right? So we have this accounts receivable of $4,000. Then we have supplies of our $350. We have prepaid rent of $5,000. And now here, this next account, this is where things are getting a little different. We have equipment, but you'll notice that that $15,000 now moved into the middle. That's because we had this accumulated depreciation on the equipment. So we're going to have to do some calculations here. And whenever we have to do calculations, we put those numbers in the middle, right? So we had $15,000 worth of equipment, $125 in the accumulated depreciation equipment account, which gives us a book value of $14,875, right? So that's what the equipment is worth to us on our books after it's depreciated a little bit. So that's all of our assets. And so once we list out all of our assets, we want to total those up. So our total assets will equal $59,225. So that's the left side of your accounting equation, right? That's the assets equals portion. The right side is liabilities and owner's equity. So that's what's going to come next here on this balance sheet. So we then want to list out our liabilities. So we write liabilities, and we have 3 different liability accounts, right? We had accounts payable of $8,500. We had unearned service revenue of $8,000. And we had salaries payable of $1,800. When we have multiple liabilities like this, we want to also be able to show our total liabilities. So we add up your accounts payable, unearned service revenue, and salaries payable amounts. You'll end up with $18,300 for your total liabilities. So now we're done with the liabilities part. So now we can take a look at owner's equity. So owner's equity, again, that's a category, right? That's just like liabilities or assets. The owner's equity account that we're going to be listing is owner's capital. Now, we get our owner's capital balance from the owner's equity statement, right? If we took that $30,000 initial balance that we had on our adjusted trial balance, things wouldn't add up here on the balance sheet. So we're going to want to make sure that we take our owner's capital amount from the owner's equity statement. So we put that $40,925 there as the balance for owner's capital. Now, we have to show that our accounting equation works out here, right? We have to show that your assets equals your liabilities and owner's equity. So we need to add up some numbers here. Your total liabilities and owner's equity. How do we get that? We take that total liabilities amount of $18,300 and we add in the owner's capital amount of $40,925, giving us a total liabilities and owner's equity of $59,225. You'll notice that's the same number as our total assets. That is not a coincidence, right? This is one of those situations where they need to equal. Your total assets must equal your total liabilities and owner's equity. Now, the good news, if you've done everything right up to this point, they're going to equal, right? So there shouldn't be too much worry into making sure that everything equals. It will happen if you've done all the other steps correctly. So, your total assets equals your total liabilities and owner's equity. You've prepared a balance sheet. So you have now completed the financial statements that you need to make in this problem. This last couple steps here are all about closing entries. So we wrap up the accounting cycle with these closing entries, and what we're doing is we are trying to zero out account balances, right? So we have some temporary accounts that get zeroed out at the end of each month. Accounts like revenue accounts are temporary. Expense accounts are temporary. Owner's drawings are temporary. All of those account balances need to be closed. So, how do we do that? Well, we have four closing entries that we make. And again, this is all at the end of the month. The first closing entry is to close our revenue accounts. So our service revenue in this problem had a credit balance of $17,000. So in order to close service revenue or zero out that account, we need to debit $17,000 for service revenue. So you do the opposite of whatever its current balance is. So service revenue gets debited $17,000. Now, there was this new account that popped up whenever you're doing these closing entries, and it's only here for these closing entries. So we close revenues to an account called income summary. So there's this income summary account that we will use when we're making our closing entries. Here we're going to credit income summary $17,000. So your first closing entry is now complete. You have closed your revenues to income summary. So we can now move on to the next closing entry. The next closing entry that we're going to have to make is closing our expense accounts. And we close our expense accounts also to income summary. So expense accounts have a normal debit balance, which means to close those, we're going to need to credit all of our expense accounts. So we'll skip a line because debits always go first in journal entries, right? So we'll skip a line and we'll start listing out all of our expenses as credits. So we'll list out salaries expense, rent expense, supplies expense, and depreciation expense, right? So we have those four listed out as credits. And I said earlier, we close our expenses to income summary. So the account that we're going to be debiting here is income summary for $5,075, which you may remember that number. That's our total expenses, right? So all we did to find that 5,000 number was we added up our 4 expense accounts in this journal entry, right? Because going back to a few of our rules for journal entries, your debits have to equal your credits. So our credits in that closing entry added up to $5,075. So we needed to make sure that our debit equaled $5,075 as well. So those are the first 2 closing entries. The framework of those entries are going to be consistent. You will always debit your revenues, credit income summary. Then debit income summary and credit all of your expenses. This third closing entry, what we are doing is we are closing our income summary account. So what I would recommend when working out these closing entries is create a T account for income summary. Because we can see based off of these first 2 entries, we have a credit of $17,000 and we have a debit of $5,075 to our income summary account. So if you made a T account, you would be able to tell that income summary right now has a credit balance of $11,925. So to close out income summary, we have to do the opposite of whatever its balance currently is. Its balance is currently a credit, so we need to debit income summary $11,925. Now, where do we close income summary to? Well, we're going to close income summary to owner's capital. So what's important to note here is that we are not closing owner's capital. Owner's capital is a permanent account. It is staying open. You are closing income summary. Income summary gets closed to owner's capital. So it's going to affect your owner's capital balance, but we get that 11,000 number by figuring out what the balance is in income summary after the first 2 closing entries. So that's steps 1, 2, and 3 for closing entries. We have one more closing entry that we need to do. I mentioned earlier that owner's drawings are a temporary account. So owner's drawings need to be closed here. Drawings have a normal debit balance, and so we need to do the opposite to close it out here. So the opposite of a debit, we're going to end up crediting owner's drawings, $1,000. Where do we close owner's drawings to? We close them to owner's capital as well. So these are your 4 closing entries. I want to talk about the third and fourth ones real quick here. So the third closing entry, when we close income summary, you may hear that or see that be called closing your net income. That $11,925, that was our net income amount. If you credit owner's capital, you are increasing the balance in owner's capital. Net income is added to your capital on an owner's equity statement. So what you are doing here is you are showing what happens on that owner's equity statement in journal entry form. You are adding your net income to your owner's capital in that third closing entry. The fourth closing entry, you're showing that owner's drawings takes away from your owner's capital. So we are decreasing our owner's capital by that $1,000, which is exactly what we did back when we prepared an owner's equity statement. All right, so the third and fourth closing entries just help show some of what's going on the owner's equity statement, but showing it in journal entry form. So after we prepare all of these closing entries, we can then make what's called a post-closing trial balance, right? So we've had just our regular trial balance from the very beginning. We had an adjusted trial balance after our adjusting entries. And then we have this post-closing trial balance after our closing entries. This is the final step. So, a post-closing trial balance. This is going to show every single account that is still open. Right? So it's going to show the permanent accounts that a company has. So it's going to show your assets, it's going to show your liabilities, and it's going to show your owner's capital. Because remember, we just closed out revenues. So revenues have a zero balance now. Expenses, we closed those out. Those have a zero balance. Drawings, we closed our owner's drawings out. That has a zero balance. So it would be pointless to put a bunch of accounts that have zero balances on a post-closing trial balance. So we just show the accounts that are permanent, that still have balances. We still want to list them out just like we did earlier, right? Assets go first. So we list out our cash, $35,000. We list out our accounts receivable, $4,000. We have our supplies of $350. Our prepaid rent of $5,000. Equipment of $15,000. Accumulated depreciation equipment, $125, and remember that's a contra asset, so it's going over on the credit side. Then we start listing out our liabilities. So we have accounts payable of $8,500. We have unearned service revenue of $8,000. And we have salaries payable of $1,800. Then we get to our owner's capital amount. This owner's capital amount, we're going to want to take from our owner's equity statement, or we could also find this amount by posting our closing entries into T accounts. Either way, you end up with that same $40,925 for owner's capital. So we have all of our debits, we have all of our credits. What do we want to do? Add them up. Just like we did every other trial balance that we prepared, we want to make sure that our total debits equal our total credits. So that's how you work through the accounting cycle all in one problem, right? We had journal entries, T accounts, trial balances, adjusting entries, adjusted trial balances, all of our financial statements, and then our closing entries and post-closing trial balance. So that's the accounting cycle.